let's say the world's going good in 2030. You got Kazatomprom pumping out 60 million, Arrow's come online doing 30, MacArthur River, Cigar Lake there.
Throw the kitchen sink at everything, Matty, and you've got a 180 million pound deficit. Bring it on. Expand MacArthur, expand Cigar's life, bring on MacArthur, run Kazatomprom up to full production, bring on the brownfield, bring on Arrow in 28, 29. You've still got cumulative deficits.
Righto, money miners. Geez, we're getting even more OG uranium folk, and we've had to go as far as New York to find this fella. And mate, he doesn't have a newsletter. He's not your common YouTube guy, but he's done his DD on us to see if we're worthy, and we're very flattered he thinks so. Mike Alkin from Sachem Cove. Mate, welcome to Perth from New York. Great to have you on, Cobber.
Thanks, Matt. Appreciate it, man.
Beautiful. Mate, okay, JD, I reckon we just get rid of all the bloody normal shit that everyone says straight up in every uranium podcast, and we want to dive in deep. So pretty much at the moment, over half the world wants uranium. No one wants to deal with Russia. There isn't enough uranium to supply all this uranium that everyone needs. We're in a structural potential supply shortage, and it's the big thing at the moment. That sums up the basic shit. We want to go beyond that, Mike. Did I miss anything?
Not at all, Matty. You go right ahead. You take it wherever you want to go.
Let's work our way up the fuel cycle. And I think we start at the upstream yellow cake, and let's end up towards the enrichment and what goes into the reactors. Now, JD, you can butt in any time you want, mate. There's so much going on at the moment, and so many forces at play, and especially in the spot market. And is there another market that you can compare uranium to at the moment where a couple of entities, namely talking about SPUT, Physical Uranium Trust, Yellow Cake, and a bit yourself too, you own a bit of physical, have taken up, are holding on so much of supply that the world needs? Like, considering SPUT holds over 2 years of what Arrow is going to potentially produce if it ever comes online. Is there a market similar to that ever?
So it's, I think, helping Matty put in context what spot market is. And if you think about what, let's go back to the nuclear power plant. There's no substitute for the fuel, which is uranium, which winds up upstream uranium, yellow cake, it becomes enriched uranium product. There is no substitute for that. And so historically, and long-term contracts determine it's the vast majority of where the pounds get purchased. If you look at the spot market, let's use the volumes of last year, the dollar amount. You're talking $5-6 billion a year. Let's put that in context to a couple of $1 trillion oil market, right? So, I mean, it is a rounding error. It's a needle in a haystack in terms of what it really is in terms of the market. And the spot market itself is really, because the market is defined by long-term contracts, and those are, 4, 7, 8, 10, 12 years. They're usually bilaterally negotiated between utilities and producers. Sometimes requests for proposals come out, but it's long-term. And so the spot market typically serves as a relief valve for some of those uncommitted pounds. So a producer will sell some pounds. Some of them may not have a long-term home at a utility, and they may put it into the spot market. But let's talk context here. In years where there's not a lot going on, not post-Fukushima where there's some excess pounds, but you're looking at 30, 40 million pounds. And let's talk demand. Now, there's different levels of demand you'll hear. You'll hear different numbers thrown out there. There's consumption, there's consumption plus restocking, there's a little bit of secondary demand that comes out there, but round up to 200 million pounds. You're looking at utilities themselves in the spot market will buy 10 to 15 million pounds per year. It's literally nothing. It's a rounding error for what they will buy. You may see in like this year, we're on pace to do 30 to 35 million pounds across all forms in the spot market. That would be utilities, producers who need to go in and for pounds that they have sold that they can't produce, and traders. Traders are the bulk of this market. So are the majority of the spot market, which is a small portion of the overall market. And it could be the spot market could be 15, 20, 25% typically in certain years, the amount of pounds sold. In when there's real excess supply, post Fukushima 2011, things get backed up in the system. You saw at the peak 98 million pounds trade in the spot, 106, somewhere in that ballpark, 98 to 106, depending on whose numbers you look at, in that range, but still less than half the market. But that was an anomaly. Now you're down to running at the 30, 40 million pound run rate. So let's talk about the head fake that the spot market is. When there's excess supply, post Fukushima, you're in a bear market. The price peaked in June of 07, July of 07 at 137. 200 in today's dollars. By the time Fukushima came around, the price was in the mid 60s, the normal ebbs and flows of supply and demand. And then from there, at that point forward, it goes down to $18 in November of 2016. There's excess supply. It's coming into the spot market. Well, that spot price is an indicator, a reasonable indicator at that time, because there's all this surplus of what's out there. Now, the volumes start to pick up, inventories get drawn down, you start to get the utilities don't recontract, they start drawing them down. But then all of a sudden you start to move forward and you start to get to where you are now. Now we've seen people worry about excess supply. You go from $18 pricing to where we are today at $90 pricing. But in that market, it's all about mostly trader churn. It's mostly traders, and you could count on less than two hands the number of physical traders in uranium that are getting offtake from a mine, small amounts, a few 100,000 pounds here or there, that come into their hands, and they are immediately trying to flip it like a game of hot potato to someone else. And they'll do it for 50 cents or $1 or 25 cents, whatever they can get per pound. They may have some sold into a utility on a short-term deal. Oftentimes they don't. So at the end of the day, the investors will look and say, what did the spot market do? Well, the spot market is determined by people with a 2 to 4 week time horizon. That's what a physical trader does. If you talk to a physical trader, almost all of them, they have very little balance sheet, very little ability to keep it around. They get it in, they want it out. It's a game of churn. And so without their time horizon is 2 to 4 weeks, not what we're going to talk about or what you guys talk about with other guests or people looking at it who are looking at, wow, look at this. There's a structural deficit in the market. These are long-lived assets to build on the mining side, same thing on the reactor side. That's not this business. This is just a very, very, very short-term nature. Most of the physical buyer of it, the buyer who consumes it, is not in the market. So the SPUT, for example, we are a considerable size holder of SPUT, as well as we own physical uranium. We are in the market buying physical uranium. But SPUT in 21, when it came out, it cleared out a lot of those excess pounds that were in the market. You fast forward to 2023, they bought a few million out of almost 60 million pounds, yet the price of uranium doubled. They were irrelevant in the market. This year, they've bought a few 100,000 pounds. The price is about flat on the year. But the point is, they cleared up what was floating around in the excess market. Last year, the market went parabolic without them really being any part of it. So those who are focusing on SPUT, now they do hold pounds, yes. So they hold 60 some odd million pounds, like you mentioned, that would be a couple of years, maybe a little bit more than what Arrow would produce. But in terms of their impact on the spot pricing today, what you will see is the traders, if they sense that SPUT is going to trade at a premium, they could raise a little capital and they could go buy a physical uranium, they'll go do that. But we talk to the physical traders. Again, we're out looking for offers on it. What are you going to sell us? They still think that SPUT is this impactful vehicle, but like so many things, the narrative is not supported by the facts. It's not even close. What's happening is the spot market has very little volume in there. There's very little supply, which will lead to volatility in that market. We're talking, again, you're talking if the world's going to consume, well, so we have it, to 10, 20, 30, 40, pick a year, million pounds of uranium. You're talking this year, it's on track to do 30 million pounds. It's nothing. So the spot market is a head fake for investors. Where we focus, I don't care where investors will do what they're going to do. Where we focus our time is what's happening in the long-term contract market.
No, so if SPUT, say if that 64 million pounds got injected into of yellowcake, went into the nuclear industry, went through the fuel cycle, and was there to supply reactors, how much of nuclear power could 64 million pounds supply? Like context of how much is that in terms of power supply?
A third of a year.
A third.
I mean, they're going to, yeah. I mean, so, this gets into what is demand, right? I often see people throw demand numbers out there. Uranium demand is a function, pure and simple, of two things. One, obviously, how many reactors are coming on the grid, going off the grid, and what's the appetite for development and construction and so on and so forth. How many are in construction? When a new reactor is in construction and it's going to come on the grid, it's going to consume 2 to 3 times more uranium in that initial fuel load than it will to begin with. That's one thing, but the real thing on the margin difference in uranium demand is enrichment capacity. And so often I see people will use a point of reference for how many pounds go into a reactor. It's not that it really can't be done that way. And the reason for that is enrichment capacity is a function of, if you start it back from the fuel cycle, you mentioned upstream to downstream, comes out as yellow cake, it gets converted into a gas called uranium hexafluoride. And then uranium hexafluoride, right? So uranium isotope is U-235 and U-238. U-235 is where the fission takes place, but it only has 0.7%. It needs to get up to 3.5 to 5% for a fissionable reaction to take place. U-238 is 99.3% of the atom, and that can't create a fissionable reaction. So they have to enrich it. And so when they're enriching uranium, think of it like an apple press. All enrichment is force and feed. That's all it is. It's done in the unit of work called a separative work unit. SWU would be what it's known as in the industry. And what they're doing is they're feeding UF6 into centrifuges that spin at 50,000 rotations per minute. And once they're on, they can't go off. They will get out of balance and the machine will be pretty much rendered ineffective. And so you're feeding UF6 into the centrifuges being the force, the UF6 being the feed. The feedstock to the UF6 is U308, uranium. So force and feed. And so what happens is if you were to think of it, you use the analogy of an apple press. If you wanted to get a gallon of apple juice, at a certain time, you could put a bushel of apples in and you squeeze down and you could get a gallon. Well, if you needed more gallons than was possible, you would have to feed more and more apples in there to try and get it. So when you have too little capacity, you just keep feeding more apples and you could probably get the same amount of output. If you had too much capacity, you could keep churning the apple churn and keep going, and you could do so with less apples. And so there's certain times where you need more apples. There's certain times where you need less apples. And that depends on how much capacity there is. So when there's too much enrichment capacity, you need less uranium hexafluoride. When there's too little uranium or enrichment capacity, you need more uranium hexafluoride, UF6. Why does that matter? Because the market shares in the enrichment, there's only a handful of these enrichers in the world. The Russians control low to mid 40% of the enrichment capacity. And China has 3 to 5% of enrichment capacity. And then you get to the West, you get to Orano, the state-owned enricher of France. And then you get to Urenco, which is a Dutch, English, and German organization that's privately held that enriches, and that's roughly half the market share. Well, so in a normal environment, there's roughly 60 million separative work units. The Russians will have 25-ish million. The Chinese will have 4, 5, 6 million. Then they add some, and the West will have the balance. When you have events take place like we have in the world, and you start to see a realignment of the supply chain, there's a misalignment of available capacity. And so when that misalignment of available capacity occurs, you will start to see, if there's limited capacity in the West, the way they can make up for that, the Western utilities, is by increasing the amount of uranium in the order to get the same amount of enriched uranium product. Going back to our apple press example, there's less capacity, add more uranium hexafluoride to it. If you're adding more UF6, you're adding more uranium to it. And that's determined by, without going down a rabbit hole, that's determined by the waste stream, the tails. And so to put it in context, to wrap some context around that, if normally to get 4.2% enriched uranium, you're using 0.2 tails, and we're using ballpark numbers, that's probably going to consume in a 1 gigawatt reactor about 511,000 pounds of uranium. Now let's take a scenario where I don't have the amount of enrichment capacity that I need. I might need, and not unreasonable, and we've seen some deals signed there, to need 0.3 tails to be enriched. Well, what's the delta there? It's about 11,000 pounds for every 1/100th of a point. So in that particular case, what that one reactor might require, 511,000 pounds of uranium, it could require another 110,000 pounds on top of that. So over 630,000 pounds. So then you say, okay, well, what's the downside to that? We've seen that already. So now take your, if your tails are at 0.3, now you're at 620,000 pounds. Now do that by the number of reactors. And each reactor is a little bit different, so you can't do it specifically, but that's the scope of the delta that's out there. Now, then you ask yourself, well, Mike, you just went from 0.2 to 0.3. Where could it go on the downside? That's where we came from. Where we came from for years, and what was happening in this market was there was too much capacity, just like the price of uranium after Fukushima in March of 2011 went from the 60s down to $18. The price of a separative work unit, the unit in which uranium is enriched, that was selling in the high $175 to $200 in the last cycle, went down to $35 per unit down at the bottom. And so what was happening? Why? There's too much capacity. So what wound up happening? The enrichers didn't need as much uranium. They could keep it working in the separative work units going. So you saw a lot less uranium required. And in some cases, the enrichers were able to take the excess uranium that was delivered to them by the utility that they didn't need to put in the centrifuges and sell that into the open market. They did so to the point where it was roughly the equivalent, you mentioned Arrow before, it was roughly the equivalent of 20 million pounds per year extra uranium that the enrichers had to sell into the market, which would be like MacArthur River, which is 18 million pounds a year, the highest grade, biggest mine in the world. So we've come from a place of excess capacity and enrichment where there was not enough uranium the uranium required was less than what might be typical, to now you're going to an environment where there's too little enrichment capacity, which means you're going to need more uranium and uranium hexafluoride to get the same amount of enriched uranium product. And the terminology you'll hear is the tails are moving higher or the tails are moving lower. The tails have scope to go into the 0.3, 0.35 range. Again, rule of thumb, use 11,000 pounds for every 100th point. When you're at 0.2, the centrifuges only have the ability to go down to certain levels. When you take the blended portion of that, that on a blended basis between Russia and the West, you could get down to 0.15, 0.16. So I have way more upside to go on the tails than I do on the downside. So that's a function of uranium demand. And that's so when we talk about demand, right, it's not just saying, oh, it's X because there's this number of reactors. It's a combination of things with a big portion of that being enrichment capacity. And if you're not doing enrichment math, it's hard to get a real sense for what the numbers are.
So is it a double whammy at the moment? Because we've got a supply deficit and an enrichment deficit. So as you said before, if you're low on enrichment, you need more supply, but we've got low on both sides at the moment.
Yeah, and you've got a dispersion. So you have, if I think about supply and demand, I often get asked, like, why is this commodity different? So supply gaps can be out there. Sometimes they tend to get solved, right? Price is the great elixir, right? It just depends on what the scope of that price move is. You asked about other commodities. What you don't see is there's a couple of plus billion pounds of uranium that needs to be contracted for over the next 16, 17 years. But that's a long time, right? So you see all these numbers thrown out there. Let's talk about what's reactors under construction, mines that we know can come online in the near term, maybe not, but at least people are being talked about. Something along the lines, depending on timelines, but roughly to meet the demand by 2030. And now let's put that in context. Today is 2024. Utilities for almost all of them, their needs are covered for the next 2 to 3 years. They're buying backwards. They bought for this year. They've already bought it in 2021, 2022. So it's not buy today, put it in the reactor today. The fuel cycle is 18 to 24 months just to get it processed. So you're talking 2027, 2028, 2029, 2030. By 2030, which is tomorrow in uranium years, of all the pounds that will be required, 23% of those have not been built yet. They've not been built. So it's not like they haven't been contracted for. They don't exist. The mines are have not been permitted, fully licensed, not financed, not constructed. Right?
So what is that number by 2030, the pounds of U3O8 around about?
Again, it depends what you think of consumption versus demand, right? So when you think about it, if you want to do a demand, consumption is a function of enrichment capacity and how much, right? So, if you're in the ballpark of 200, 205, 210, depends on what one's view is of who's going to get license extensions, what reactors will come online. But it's not like a moving target like lithium trying to figure out, EV batteries trying to figure out what end demand is for EVs in 2030, right? Who knows? Those numbers have been slashed and slashed and slashed. Here, there's 60 reactors under construction. You can see what's going to come online by 2030. If in the West, add a little bit of time because they get delayed. In the East, they come on time pretty quickly. But you have a very good sense. You have a good sense of who's extended for lifetime for license extensions. So the demand side, you have a pretty good feel for. you want to take all the development ones and proposed ones, put those to the side. Let's talk about what matters right now. So when you look at that and you look at the enrichment capacity, what tails are you going to use, right? So can demand be 200, 205, 210? In that ballpark, you go out by then, but that's just a portion of it. Now you've got to start adding what we have seen over cycle, over cycle, over cycle. And this is, I think, a very important element of demand that we don't see discussed a lot is the destocking and restocking component of it. From 1993 to 2004, utilities coming off of Chernobyl in 86, you saw a big slowdown in bills. You saw a backup in uranium in the system. So from 94 to 2000 and 93 to 04, utilities were replacing via contracts only about a third of every pound consumed. They were drawing down inventories from all over the place. But from 93 on through 2013, they had 20 million in the United States. There was 20 million pounds per year that was coming into the United States from downblended nuclear missiles in Russia. There was a pact called the Megatons to Megawatts program. They downblended 1,600 nuclear weapons in Russia. The US took high enriched uranium, blended into low enriched uranium that could be used in civilian nuclear power, and took that in. For context, the US uses 50 million pounds a year. 20 million of that was guaranteed coming in. And so that was a nice buffer to have. So what happened was from 93 to 04, and I use those numbers because that's where you only saw about a third being replaced, taking down megatons to megawatts inventories, sucking down inventories from all over the place. The price of uranium is going 7, 8, 7, 8, 9, 7, 8, 10, 12, and then all of a sudden by 2000, it's 9, then it's 14, then it's 16. You get to 2004, and then by 2005, all of a sudden, when the utilities had been contracting roughly 50 million pounds, roughly a year, all of a sudden they contract 225 million pounds, and then that sets off a contracting cycle for the next several years that saw roughly 1.15%. So a replacement rate in excess of consumption of roughly 15%. So there is an addition to demand. So if you're at so fast forward, and then secondary, those are traders and other people buying the commodity, physical buyers of it. That's an actual demand number. Let's fast forward to this cycle, right? Because we need to know the last cycle to know where this cycle, because it often rhymes. From 2011 through 2022, 37% of a utility's annual needs were recontracted for. So it's rhyming with the last cycle. They were drawing down excess inventories. And now you've started to see it accelerate to where now it's almost 80%. So now we're starting to enter a contracting cycle. Again, why? Because inventories have been drawn down. Price is the arbiter there. Price has gone from 18 to 90. Well, inventories aren't abundant. And so now you're starting to see we're entering, once you get to consumption rate, now you start to restock. So demand, baseline demand, 200, 205, 210, 215. Pick a number in terms of tails you're going to use, the reactors that come on. But now then start adding another, you can add 15, 20 million pounds per annum in restocking. Now you mentioned earlier, Maddie, you mentioned, SPUT. SPUT owns a lot of uranium right now, but they're not in the market a lot. They don't trade at a premium a lot. But there are other vehicles that are being formed, right? We own some uranium. There's others out there that own uranium. It's a commodity. And so people go, that puts demand in the market. So your demand number, pick it to 20 demand, not consumption, but demand to 20, to 30, to 40, pick a number you want to go to. Then when you get to the supply that's out there, right, you're looking at pounds that don't yet exist. 20, 23, 24, 22, pick a number in that ballpark of that demand number by 2030 isn't permitted, licensed, or built, or financed or built. That in the world of mining, we know that when things go really well, delays occur all the time. Cost overruns. It's hard to find talent. So there are real challenges in the supply stack. Another 8% of that is brownfield that still needs to come online, right? So, think about, we're talking, by the way, you're probably talking new pounds, 2030, you're probably talking 50 million pounds that needs to come online, right? So that's almost what Kazatomprom will produce this year. So when Kazatomprom says we need another Kazatomprom, they're not making it up, right? But as you guys know from being mining guys, a bird in the hand is worth two in the bush. The power of incumbency is really special. And so it's nice to have these projects on the come, but myriad things happen that make them delayed. And so where you start to see that, and what's happening in the fuel cycle right now, and where we focus our attention, is the price movements within the fuel cycle, right? So you'll see, it's not just what's and I said the head fake of U308. That's the spot price head fake of U308. That's noise day to day. And again, I buy it. I think it's going higher, but I think my view is spot will be taken higher by the contract pricing now. Security of supply, long-term pricing will bring it along with it. And so, and I also think there are deficits that heretofore we have not seen, that this market has not wrestled with, that they're now going to start to get their head around. And when I think about, though, and I'm looking at the components of it, you have to think about the components of the fuel cycle as individual units, but tied together in terms of price action. And what I mean by that is you're thinking about, so uranium, U308, is the one where it has the most participants, the most suppliers. Then you go to, there's several mines, not a lot, but there's several mines. There's development projects. But then you start to get to conversion, the next phase. Conversion is a service. You're converting yellow cake into a gas, UF6, that has a price. Back in 2016, that price was $5. Today, it's $58. Why? There's only very few converters in the world. The Russians convert, Chinese convert a little. The Russians convert about 30% of the world's supply. The Chinese do a little of it. The French convert, Orano converts, Converdyne converts, which is owned by Honeywell in the US, and Cameco converts. But when the price there has gone up 10 or 11x over the last 5, 6, 7 years, that shows that's where the utilities were saying panicking, because conversion had been shut down. It was uneconomical. It didn't make sense. You only had a few suppliers. As the market started to heal, as the prices started to move up, as the normal course of business needed to get done, the converters were saying, forget it. We're not bringing this capacity online. We can't make money. And then the market does what the market does, right? Competitive markets find their balance. Well, the price there went to $58. The next phase, right? So then there's a price for UF6, and UF6 has gone up a few 100%. That's the gas. The next phase of the fuel cycle is enrichment, the separative work unit. As I mentioned in 2016, it was $35. It was $35 in 2016. Now it's 160, 165. It's had a heck of a move. But it's so, and then you start in there's spot, there's long term. Then you look at uranium, right? So where is uranium? $18. It's now 90 in the spot market. The long-term price is 80. The 3 and 5 year price, so let me look just today, let me see what it is. 3 and 5 year price are 97 and 108. The long-term price is 80. We could spend a whole show on how absurd the price reporting is, and why you've got to be in the market to know that $80 isn't $80, it's more. So the point is, what's already moved a lot Conversion has gone up 10 or 11x. Enrichment has gone up 5 or 6x. And those prices are starting to stabilize because there's some more enrichment capacity coming online. Not enough to solve the problem. They're still going to need more uranium, but that's coming online over the next 5-6 years. Again, long life, don't exist yet. You got to get the machines up and running. But what I'm focused on and what we are focused on is not the spot price, it's what's happening in long-term pricing. And it's interesting. I was running the numbers this morning. This year, as I look through, I'll go give you some numbers from 2016 through since 2016. U308 spot up 350%. The long-term conversion spot up 874%. UF6 spot up 397%. SWU spot up 251%. EUP, enriched uranium product, right? That's up 345%. Long-term price of uranium since 12/16 is up 167%. That's where this year, though, the long-term price of uranium is up 18%. All the other stuff, with the exception of conversion, is up low single digits. Conversion's up 24%. Everything else is there. Point is, long-term contracting, security of supply, prices are starting to move in the direction that you need to see it. Why? Because there's not enough economical supply to meet uranium uranium demand numbers.
That's fascinating, Mike. And I'm not going to lie, I'm going to have to listen to that all again to make it all sink in.
Jesus Christ, JD, I'll tell you what, the fear in me, old James at WA Waterbores needs to get drilling paleo channels far out. Doesn't the world need him? Russia needs him, mate. China needs him, the West needs him. Everyone needs bloody WA Waterbores to get uranium happening.
Mate, I could not have summarized it any better. The world needs James. He's up in Gero. Give him a call, give him an email, go and drive up, visit him. He is there at your service, the Australian uranium industry. Just get in touch.
Mate, James, if you listen to mate, the world needs you to drill these paleo channels. Mate, look, the water bores thing might be old for him. We're bringing in the new. Find the paleo channels. Drill them out, mate. He could be drilling all the friggin' wells for these ISR mines, mate. I reckon James is going to be one of the busiest men in WA, and I don't think it's going to be just WA soon. I think he's got to go all around the world, JD. I think, mate.
Mate, you've taken the words out of my mouth. The Goldfields is just where this business started, you know. He is moving on. We know they're doing a bit of this ISR stuff in South Australia already. It's going to happen all over Australia. It's going to happen all over the world. And there's only one company that I trust to do it.
Right. And so, look, if you need a water bore or any water bore installation, piezo's, bloody anything water bore related, get James now because he's about to go gangbusters. WA water bores, soon to become WA uranium bores, soon to become world uranium bores. Good on you, James.
There was heaps of information there. And, you know, you've clearly been in the uranium space for quite a while now. You were one of the earliest sort of groups to set up a uranium-focused hedge fund. And there's a couple other players that sort of come to mind that have similarly, pure play nuclear or uranium funds. Sagra, Tribeca, these sorts of names come to mind. And I'm interested to hear from you, given that a lot of the talking points, there's bits that you go into in quite great detail, but a lot of the broader points you have in common. Are there areas where you sort of see your views being quite different from some of these other pure play funds?
So, I mean, we're friends. I'm very good friends with Art and Adam, who run Segra. It's a lonely island out there when, back in 2018, when Art and Adam was starting, I think I started around that time, maybe at Tribeca a little bit later. But there were just a very small few of us. And you show up at nuclear power events, not investment conferences, but where you go find the fuel buyers and whatnot. So, I can't speak for them. But it's the same type of work. It's having a baseline going back 5 years. I went to the Nuclear Energy Institute in 2018 and said, the industry forecaster is wrong. They said, who are you? I said, I'm just some guy who could probably do fourth grade math, but I did the fourth grade math, and I'm telling you, the forecaster is looking backwards, not forwards. And they said, get out of here. The NEI is the largest trade body that represents people in lobbying in Congress. They represent the U.S. fuel buyers. And I went to them several times, and I had no background in uranium. We just spent a couple of years looking at it, and they were eventually let me give them a presentation. And eventually I showed them where I thought that industry bellwether forecaster was just flat out wrong. And they let me present to their annual conference in 2018, and I did it again in 2019. And so I have a baseline of talking to the cohort that buys this stuff and seeing where they're at, and they're not interested in outside opinions. And so we have been told we're wrong since $18. We have been told at $18 they'd be paying 15. We were told at 30 they'd be paying 25. We were told at 50 they'd never pay more than 40, and here we are. So you ask Segra and Tribeca, they've had the same experiences. They're at the same conferences. They view the world similarly. I won't speak for Art or Adam or Guy at Tribeca, but at the end of the day, it's having a difference with where you think ultimately the demand numbers are based on forecasts, right? And let's understand how this works here. The forecast. If you were a uranium analyst post Fukushima, you were fired for the most part. Very, very few survive on the sell side. So it was left for dead. Commodities down 90%. The numbers, companies are down 90%. The institutions are gone. So it's abandoned. It's left for dead. People assume nuclear is dying. And all of a sudden, if it perks its head up a little bit, but if you were assigned at an investment bank to cover uranium, you were a base metals or a precious metals analyst. What I just talked about with enrichment capacity and conversion, there's a ton of stuff you need to be spending your time on 24/7. If you're not doing that, you're not going to be able to stay on top of it. So what winds up happening is if you were an analyst in 2015, 16, 17, 18, covering this sector, you were looking at the bellwether forecast numbers and sourcing it. That's all you were doing. And so if the source of that information was backward looking, so was your numbers. And so that's where the delta, that's where the alpha comes in, is where, what's the difference between what's out there and how that sausage is made, getting to know the people who buy this stuff. So yeah.
And just
I would say it's a different, yeah.
Yeah, I mean that's fascinating what you talk about the sell side and the way that fluctuates around, how much business they can sort of write essentially. And there was that sort of period for a long time where there was not much business to be written from the point of view of a sell side analyst. And it sort of makes me think of a sort of blog post I saw not too long ago, just in the last week, from a fund manager in Sydney, and the sort of quote that he said was that all these sell side analysts are now starting to come to him and pitch uranium to him when he'd been pitching that to them 4 odd years ago. And Paladin was the stock he was referencing. Back then it was a $200 million market company. Now it's $4 billion, and now he's getting pitched the stock. And I'm curious to hear how the sort of newfound popularity in the uranium sector makes you feel about the sort of longevity of your trade here.
I was asked to speak to at an investment conference in the Bahamas about 4 weeks ago, maybe. And there were 28 to 30 people in the room, and a couple of the largest sovereign wealth funds in the world, a couple of the most successful mining entrepreneurs in the world, 2 of the largest asset managers on the planet with trillions of dollars, heads of them. This was a very, very small, very bespoke group of people who have massive amounts of capital.
Geez, Mike, if you can get us an invite to that one day, that'd be bloody great, mate. That'd be that'd be unreal.
It was called the 13D Brain Trust conference, and run by Carol Sokoloff, who runs 13D. And like I said, it was in the Bahamas. It was 28, 30 people with huge amounts of capital in the room, very sophisticated investors. Almost all of them came up to me and said, I haven't heard about this uranium trade at all. Tell me about it. Almost all.
Yeah, wow.
All. Sovereign wealth funds knew. One of the sovereign wealth funds had been doing work on it. One of the asset managers, a multi-trillion-dollar asset manager who has several hundred people working for him, said, everyone's telling me, all my guys tell me we should be buying copper. Tell me about uranium. I haven't heard it. So it's easy to be on Twitter. It's easy to be on YouTube and see all these people talking about stuff. In the institutional world, it's still being out there. And look, my baseline here is the sell side analysts, watching some of them through the trade, some of them in 2018 and 19 and 20 at some of the bigger banks that started to cover it, just cutting and pasting the industry forecaster, whose work I think is abysmal. And so when we saw that, and we would be all over them saying, listen, this work is nonsense. You're cutting and pasting. It's BS. And to watch the evolution there, that's pretty cool. We just saw Goldman Sachs pick up coverage a couple of weeks ago. And so people, it's people flippantly say, oh, well, Goldman's there. So yeah, I guess the trade's over. Their clients are just hearing about it, right? And so we're always looking. I spent the first 10 years of my career as a deep, die-hard short seller. That's what I did. I went looking for bad companies run by bad guys or really bad businesses. Every single day I was looking, and you get your face ripped off if you're wrong. And you do even if you're right sometimes, if you get the timing wrong. And so I wake up every day asking myself, where are we wrong? And I have 3 other guys every day in my firm doing the same thing. Where are we wrong? What are we missing? What I don't do is, oh, it was on CNBC, the trade's over. Oh, this guy talked about it. I worked at Zweig Domena, one of the largest hedge funds in the world. And one of the guys described was Marty Zweig. And Marty Zweig, God rest his soul, he's passed now. But Marty Zweig's the guy who said, oh, if it appears on 3 covers, then it's over. I worked for him. I sat in those offices. I was there. So he didn't mean if it appeared in a 30-second spot on CNBC, or that was not the spirit of that. So this trade is still very new. A lot of capital don't know it. How they express it, it can be in different ways. And look, the companies you're referencing, I own some of these companies at one point that were many, many multiples that I don't own now. And then you rotate your capital, you look for other ways to express the view. So I think for those who use the rule of thumb and are a little bit more flippant and just assume that the trade's over, then yeah, maybe it shouldn't be for them. They should go do something else. I think the asymmetry here today is as spectacular as it was when I first started looking at it in a different way, because the buyer has waited so long. The supply horse left the barn. I said that in 2018 in Boston at the NEI conference when I spoke to fuel buyers. If you don't start contracting for your future book right now, it's going to be too late. And here we are. I ask anyone, what commodity, looking out tomorrow, 5 years, 6 years, almost a quarter of the supply that's needed doesn't yet exist. It's not built. I don't know I don't know another commodity like that.
Well, I want to round out on that your 2030 point and saying that, whether things aren't built, aren't permitted. So if I just did some work on your 230 million pounds required. So let's say the world's going good in 2030. You've got Kazatomprom pumping out 60 million, Arrow's come online doing 30, MacArthur River, Cigar Lake there.
Throw the kitchen sink at everything, Matty, and you've got a 180 million pound deficit. Bring it on. Expand MacArthur, expand Cigar's life, bring on MacArthur, run Kazatomprom up to full production, bring on the brownfield, bring on Arrow in 28, 29. You've still got cumulative deficits.
180 per year?
Could it be 200? Could it be 150? Could it be 130? Could it be 210? You can't be exact in this stuff, right? But it's not surpluses. And so let me give you a little context for why that matters. In the last cycle, the entire narrative is bullshit. And let me explain to you why it was bullshit. Because if you listen to today, what people will say is, oh, the reason the last time prices went higher was only because Cigar Lake flooded. Okay, why don't you tell me you don't know what you're talking about? Not you, but when people are talking that. So let's separate narrative from facts. In 2000, the price of uranium was $7-8. By 2000 the flood that gets ascribed to the reason the bull market went or there was a bull market in uranium, was Cigar Lake was scheduled to come online in 2007, and it had a small flood in early 06, and in October 23rd of 06, it flooded. The whole thing flooded, and so the largest mine scheduled to come online at 18 million pounds. Think about it, at that time, 170 million pounds of demand, roughly 10% of world demand is coming online the next year. It floods. So the price of uranium at that time, though, was in the 40s. So the price had gone up 7x. If that's not a bull market, I don't know what is. From 2000 to 2006, prices up 7x. Now it's in actually the high 40s. All of a sudden, the flood comes. And so if I were a fuel buyer and I were looking at the industry forecast, and I said, okay, what's my typical contract like? 6 years out. And if I looked forward 6 years, I would have seen a surplus, a cumulative surplus in that market of 125 million pounds. So the price of uranium then settles from the high 40s. By the time January of 07 comes around, before the bellwether forecaster puts their new numbers out quarterly, the price of uranium's in the 60s, right? So it's moved up, but it's not gone crazy. If I look at the next forecast, the surplus went from 125 million to 225 million for the next 6 years. What? 18 million pounds a year just came offline. They said we don't know when it's coming offline. Yet the surplus went up 100 million pounds. What did the price of uranium do over the next 9 months? It went from 60 to 137, and spot market contracts were being signed at 85.90. So that was with the surplus. Today, again, if I take a normal, a commensurate tails level, I enrich at the enrichment, I look at what the demand numbers are, I look at a little bit of secondary, I look at a little bit of restocking, a drop of demand coming online. Now I look at what the mines that need to be built. There's talk in the market of, so Cigar Lake will get extended an extra 6-7 years. There's talk of McArthur River going from 18 to 25 million pounds, which is its capacity. Doesn't mean it's being done. Let's throw that in. Let's take the Kazakhs and ramp them all the way up. And by the way, the Kazakhs, I mean, I can't even, the numbers, if their USD capex per pound was up 31% last year, on a tenge basis, up 30%. If I look at what Kazatomprom, when they came public, again, history informs, their projected all-in sustaining cost in 2019, when they came public in their IPO document, they said that $15.23 all-in sustaining cost was going to be by 2023, $13.29. What was it? $21. What are they guiding to in 2024? 26 to 27.50. So the production stays where it is. You're in the mid 50s. Maybe they get that. We throw them into 80 million pounds a year. We then take on the brownfield. You still have deficits. Again, is it you want to get to 180? Could it go to 200? Could it go to 130, 150? It's not exact, right? Forecasting is challenging. But we're looking at, on the margin, are they surpluses or deficits? There are big structural deficits. And that's not to be confused with the price of uranium in the spot market goes up or down $5 a pound in a day or a week or whatever. That's just a few people trading hands. That's where the head fake occurs. It's a de minimis amount of pounds where viable economic supply meets fixed demand and growing demand at almost 4%, 3.5%, 4%. That's where we're talking about. So that's where, what happens when contracting, which we're almost approaching. Last year, you were getting close to replacement level. That's where the utilities start to say, and that's where, like you see right here, the one that lags since 12/21, right before the Russians invaded, and Russia's 45% of enrichment, 30% of conversion, 15% of uranium. So they're big, they're a huge player in it, right? The lag in all of that is the long-term price of uranium, right? Everything else is up 120 to 200%. This is lag that. That's now, but when does that occur? When they start contracting a replacement rate, and that's what we're approaching. So in the last cycle, prices went to $137, which are $200 today, with a surplus in the market. Where does that go when there's a deficit in the market? The market will figure it out. If you want to go out to 2030, you want to use a couple of 100 million pounds, depending on the tails, right? So Could it be a 205, 210? Could be, right? I don't think it's going to be much less than that, right? Because capacity is tighter. So your tails are higher. So your demand is higher. But then on that number, so let's use 200 million for demand. Now 205. Now take though, you're restocking. It's a real number.
Yeah.
It's not. They restock. So in the past, they would have done when they destocked, right, at a third of annual consumption for 10, 12 years, they then restock, destocking and restocking. And when they restock, you add another 15, 20 million pounds of demand, it's a real number. They contract for it. Now add your capital coming in, your financial capital that's competing for those pounds. So your demand can get up into those 230s plus on annual demand. On the supply side, you've got a misalignment too, right? You've got 65% of global supply that comes out of the East, a little bit more. But the demand, 65-ish% comes from the West. So you've got a realigning supply chains right now that are happening. But the mines need to come online in the West. So what we do is we take all of those, the supply stack, right? One of the things I often hear a lot about is, this one's coming online, that one's coming online. Great, awesome, 2 million pounds. What do you get? What's next? You've got in a given year, you've got a 20, 30, depending on the year, 40 million pound deficit. Doesn't solve the problem. It goes towards it. But you've got a structural deficit. Where it gets realized is when long-term contracting starts to meet the consumption at replacement rate.
So is that has the uranium even been discovered enough? Like, even if you said things aren't permitted and
totally
everything, like is there actually a deficit in what's actually been discovered yet? Or is it it's there, it's just not been built?
Yeah, there's an abundance of uranium. That's not the problem. And so there's plenty of uranium, but it has to be economic, right? So
I guess economically discovered deposits.
Economically discovered plus developed. And so if this were 5-6 years ago and they were already contracting, now you're up against a time crunch, right? So how does that get solved, right? One of the nice things is if you were to go back into the mid 2015 timeframe, people were talking about the bull market emerging. Remember, the reason Japan at the time when Fukushima went down was 13% of global nuclear power. And so a lot of demand went offline. 54 reactors went offline out of a base of 440. That's a lot. And so you had it just kind of back up into the system, and you had this extra enrichment capacity. It all goes back to all paths lead to enrichment. And with this extra enrichment capacity, you had utilities still delivering the amount of feed to the enricher, and the enricher didn't need to use it all. And they wound up selling the equivalent of the world's biggest mine into the market through a process called underfeeding. So they were able to sell 20 million pounds roughly into the market without a mine being built. That was pretty cool, right? In an already down market. And because the cost to enrich is basically electricity, it's once those centrifuges are on, there's very few people involved. It's automated. You keep them on. Any little bit extra they could do, they sell it into the market. Good for them and from their perspective. that exacerbated the excess supply. Now flip it on its head when there's too little supply, right? When there's not enough capacity, you just need to solve it with more uranium. And you can do that. So underfeeding in the downturn cause prices to accelerate to the downside. The way you avoid running out and reactors closing down is you can move the tails higher, which means you're overfeeding, and which means you can produce more uranium, more enriched uranium product. But the one thing that you find is it's not an issue. There is plenty of uranium in the world. It's timing of that, right? It's getting it developed. Maybe next gen comes online in 2027, 2028, like they say. I don't know.
Probably not.
But probably not, but maybe they do. Who knows, right? But we factor that in. And so, we're talking, and it's the cohort, right? And that's just based on my experience. I can't speak for others. My view is when this cohort, who's lackadaisical, they're very smart nuclear fuel buyers or nuclear engineers, but they're in the market so infrequently, and they're doing so many important things at their reactors to be burning the fuel efficiently, they're securing supply, all the different components, making sure the enrichment EUP is there, and the fabrication. These are smart people. Almost the uranium is oddly, the feedstock to it all, because there's more suppliers of it, they tend to be complacent there. And that's my baseline. I mean, that's why I started Sachem Cove, is because I spoke to them back in 2016 and 17, after I'd done a lot of work. And what I realized was they weren't commercial creatures. Why? Because the cost of uranium is de minimis. The entire front end of the fuel cycle, all the things we talked about, is 20%, 22% of the operating cost. Uranium is mid-single digits to high single digits, pick a number, depending on price of uranium. Coal and gas are 80 to 90% of the feedstock. So there's not a financial incentive. They're not structured that way. They're structured, the fuel buyers who are really smart, their job is to secure supply. One of the things of living in this world for the last several years is they just keep following price up, because there's no incentive for them to do it. Nobody's sticking their neck out. They don't get paid to do that. They get paid to secure supply at whatever price everyone else is paying for it. And they waited too long. And they just did. And that's going to come home in the form, our view, in when long-term pricing meets when consumption, economically viable supply meets long-term contracting demand at 1+, meaning 100% replacement rate, which we're almost there on an annualized basis. That's when you start to see prices really find their level.
Well, surely that structural supply deficit is that going to impact the rate at which these nuclear reactors are going to be built? Because why would utilities build nuclear reactors if they are unsure if they're going to get the feed to put into them?
Good question. So, if you think about right now, demand, there's 60 reactors under construction, and give or take, some will be delayed and some will, but you could look at and see the timeline in which they'll come online by 2030. And so they'll have bought their fuel, 3-4 years ahead of time on that. And so they can arrange for that by using more enrichment capacity. So they can get there by doing that. And then as you get out further, you get into the mid 2030s, these reactors, I mean, if you're in the West, it could take 7, 8, 9, 10 years. If you're Chinese, building in 5, 6 years. So for what's coming down the pike, there's a line of sight. It's the next iteration, but then that will get solved by the utilities securing supply via long-term offtake agreements, which then will enable the mines to go get their financing and then enable them to go get built. So it's just the natural course of things. You're not going to see them run out of fuel. And look, at the end of the day, at some price, I don't know if it's $250 or $300 or who knows. I don't know what the price is. And at some price, there's inventory that somebody's sitting on. It's that can come out, right? There's depleted tails. There's stuff that can be done that are not economical today, but in the future at much higher prices can come on the table. So again, it's not a matter of is there enough uranium? Is there enough economic uranium? And timelines matter. And look, at the end of the day, if you get to these situations where I saw somebody say, well, with SPUT, will the government interfere? I don't know. I don't think they will, but maybe they will. I don't think so. I don't see a scope for it. It's a commodity and people are out there. I doubt they will. But if it got to that and there's such desperation to get to that because they really need it, where's the price of uranium? It's already gone parabolic. So a lot of the reasons why you can get to these next level of things that are out there that would cause supply to be met, the prices will have gone nuts. In our view.
What price do you reckon, spot price do you think that the SPUT would see a shareholder vote in favour of selling it?
It's interesting. SPUT is really an expression of people's view on uranium. It's a way to express the view that I think the price of uranium is going up. Let me go buy that. Since I can't buy physical, I'm saying how a person could think about it. Since I can't buy physical uranium, most people can't. It's hard. I mean, it's a lot to get approved to store it and stuff. You got to go through a lot. It costs money and stuff like that. So it's just a way for somebody they're really holding uranium for somebody to express the view on it. And that's the vehicle. It's not about taking physical delivery of it. So I don't know what that price is. I view Sprott now, the incremental pounds they can buy, that's great. If they're in there buying it, so be it. If they're not, so be it too. The market will do what the market's going to do without Sprott buying pounds or not. Put that in context though. That's 60 million pounds. Like I said, you're talking a third of a year of demand. That's not going to solve anyone's real problems.
We've seen
utilities have supply deficit problems.
We've seen a bit of M&A already in the space over the past year or so. Do you see the sort of wave of consolidation heating up more and more? It's the angle we've sort of spoken about it is that it's in the interest of a lot of these players to get more of those ETF flows to be bigger entities, hence they merge and so on. Do you see it the same way?
Yeah, I mean, it's hard to get synergies in mining. These tiny companies maybe eliminate some small company costs, but the flows could come in because they're a little bigger. They qualify for different things, so you could see some of that. I think it's tough. Mining's a hard business to invest in, junior mining especially. And you start to see more companies come into the mix. Commodity tourists, right? They go to wherever the commodity's hot, and you start to see some more of that. I think, like in the United States, there could be consolidation. I wouldn't argue for. I would think there's a case for it. And where that would make sense is when you have smaller deposits. One of the things, great is king, right? The bigger the better, the more tons you move, and it's hard to argue with that, but in an environment, I think, where you have shortages, I think every pound matters. And so, if you have a 500,000 pound, a few 500,000 pound deposits and 700,000 pounds, and those could be geographically close, and they could add up to a couple 3 million pounds. I think it makes sense to do that because you'll have better economics, you'll reduce some overhead costs, and I think the U.S. has the opportunity for that to happen.
Bloody hell, JD, Seamus Murphy's ears will be pricking up listening to all this, mate, all this work that's going to come to get this uranium industry going. Geez, they need Australia, and Seamus is going to deliver it, I reckon. The people,
mate,
the drilling, friggin' everything. He loves cutting uranium core and storing it.
We know Seamus has been a phenomenal supporter of the potty. We know he's tuning in and listening, and I reckon his ears will just be bloody ringing. There's that many bloody opportunities going on right now. core cutting, storage, JORC reports, anything, you name it. Anytime exploration services can do it. So if you're a company listening, there's only one name to call.
Mate, Seamus just sees dollar signs at the moment. He knows him and Anytime Exploration are the people to get this done. Supplying the field, all the exploration workers and everything you said, JD. In addition to WA Waterboards, mate, they are going to power the world, and we're handing them to the world, the nuclear energy world, on a platter. Get in touch with Anytime Exploration, and mate, they will help you find uranium.
Well said, Matty. Support a local WA business. Seamus Murphy, he's the man.
Seamus Murphy, good on you, Seamus. Before we get on to, I want to get on to conversion and enrichment and SMRs, and we'll tie it all in. But before we do,
let's do it.
Do you think, Mike? Do you think has Kazatomprom been affected by these floods or not?
Yeah, I don't. So we have people on the ground that we speak with over there. Where the floods are have not been where most of the mines are. So
it appeared that way, but you see a lot of mixed. I think there's a lot of Twitter in the news that are heavily invested in uranium that nearly make up the story to say they have been affected. Because the thing that, so you don't want to get me going down a rabbit hole or on a tangent here, but the catalyst you think it is never a catalyst. It's always the stuff you don't anticipate. And if it's a catalyst, it's out there, it's known. What are the catalysts? I think in this case there is flooding. There is the Ural River is overflowing right now. The way I look at it is the Kazakhs are having a really hard time producing uranium at the clip that they thought they were going to. This is the way I look at Kazatomprom. I go back and look from 2019 when they thought the tenge was going to be into the future 340. And they thought that they were going to be producing uranium at an all-in sustaining cost of the mid $15 range by 2023, 2024. And I fast forward today, the tenge is at 460 tenge or whatever it is, 450 tenge. So it's depreciated even more. They're on a dollar basis, they're going to produce this year, they're guiding to 26 to 27. I think it's tough to produce uranium. I think it's hard. I think that a lot of the low-hanging fruit for them has been developed. Remember Kazatomprom, if you looked in 2005, they were producing 9 million pounds, and they were forecasted to produce by 2014, 19 million pounds. That was the forecast. By the time it got to 2014, they were producing 56 million pounds. So, think about that. So, were they getting the good stuff really back then, and leaving the harder stuff behind? Because it's been hard for them to get to anywhere near nameplate capacity. I know what I would have done as a mine operator. You take the easy shit first. It's been happening forever. Why the fuck wouldn't you?
Exactly. And so now, there's been a series of things, right? You've had value over volume. And so that's worked. The value over volume. But I think it's almost been, they've had to do that. Right, value over volume, don't pump it up. I think because it's hard to produce as much uranium as they think they could at nameplate capacity. So I think that's been a nice strategy for them. They're being disciplined, but I think it's forced discipline also. So I think you've seen that. Their costs are materially higher than they thought they were going to be. Last year, yes, they had an acid challenge, right? Because 60% of sulfuric acid is used in fertilizer. There have been challenges getting it out of Russia. China can't provide it to them because China needs it all for themselves. They're bringing it in. They're bringing catalysts in to use it. And also, you can't, it is not produced in the west of the country in China, so they can't get it over to Kazakhstan. It's really hard to transport. But it's a series. It's constantly a series of one-off things, and on a per pound basis. I was just going over this when I was pulling up our numbers. like I said, CapEx per pound is up 31% last year. I mean, these are some big numbers per pound produced. So are there floods there? Absolutely. Is it going to close a mine down tomorrow? I don't think so. Could it present challenges to getting stuff to site? Yeah. Transportation wise, could it present challenges getting transportation out, whether it's through the Trans-Caspian route or getting up to St. Petersburg? It makes it more challenging, but I don't look at it to say, this is where Twitter drives me nuts, where it's state specific, time specific. You don't need it. It's just normal course of things. It's hard to produce uranium for them right now. It's costing them more money than they ever thought. And this is just one more challenge for them.
God, that Trans-Caspian route sounds like an absolute shit fight. Ben Feingold give us the rundown on it. I'm like, far out. Wouldn't that piss you off when you know you could? Oh, it'd be so much easier just to take it to St. Petersburg. But okay, let's assume, and this is an crystal ball prediction, whether it's likely to happen or not, is that US Senate bill gets passed, and the West is going to sort of decouple itself from Russia in terms of uranium, and then which would mean, right, the West needs to bring on more conversion facilities, more enrichment facilities. How hard and expensive is each conversion facility and an enrichment facility to bring online?
Great questions, Matty. So think about SWU capacity, as I mentioned earlier, in the world of 60 million SWU, separative work units. If you want to think about CapEx, think about $1 billion for $1 million ballpark. $1 billion to bring on a million SWU. And then you want to start to break down the SWU capacity by open market and closed market. And when we do our supply demand work, you're thinking how much, if you look at the movements of the world geopolitically, what's going on, how many more SWU units do you probably need? And then you could pick a number from 5, 6, 7 million SWU, and then you look to see 8 million SWU, somewhere like that. And both Orano, the French, and the Dutch, English, German, Urenco, have added capacity commitments by 2030 of something like 3.5, 4 million SWU. Again, they don't exist yet. To build these centrifuges, so you still need more SWU, which will require, that's not going to be there. That will require higher tails on the existing plants. But the maker of the centrifuges is a joint venture between Urenco and Orano. And that's been, just like the mines were down for 4 or 5 years, that has been on care and maintenance for 4 or 5 years. And one of the biggest challenges in mining is finding skilled labor. And I think it just like they're going to have to, when they turn everything back on to make these centrifuges, you got to find world-class welders. Not easy to do. You've got to take the mothballs off. So again, like anything, any project, you'll expect delays. So the enrichment capacity, there has been some movement. That's all factored into our math in terms of tails and how we think about it. So you've seen some of that conversion. You've seen, but again, we don't think there's enough enrichment capacity coming online, and it will take years. And same with conversion. You need more conversion. There's the French and have been trying to bring on more conversion for years, not very successfully. There are a few million units that Cameco, with their Westinghouse joint venture in Springfields, United Kingdom, could bring back online. But again, it would have to be for a certain price that they would have to do it. And that's why you've seen UF6 pricing, conversion pricing, up 10x to try and incentivize them. And Converdyne in Illinois, which is owned by Honeywell, could also bring it on. But again, they're going to want certain pricing to do it. It's like anything. Price is the great elixir. And there's, after prices having gone up as what they've gone up, like in conversion up 10x, and they're still not bringing capacity online. The utilities are saying, WTF, like, what's going on? Come on. And the converters are saying, what they forget is converters they lost money for a lot of time, or they weren't making as much money. They're in the profit maximization business. And one of the things you'll hear, I often hear Grant Isaac and Tim Gitzel at Cameco on their conference calls, who I hold in great respect. I hear them say that the utilities are great partners, and they're wonderful partners, and they're our business good partners. No, they're not. From an investor's perspective, they suck. From a partner standpoint, the miners were on their knees. The biggest mines in the world were having to close down, and they were saying, "Look, as these contracts expire that enabled us in this excess supply period to stay in business are expiring, we cannot keep these mines open. We need longer term contracts." And they're the ones who aren't worried. The uranium's a small portion of it. We just need higher prices. And what happened? The forecaster, the bellwether forecaster, by the way, if you looked at the cost curve, took what was a full cost that they called in 2013, which would have showed, let's say, MacArthur River and Cigar Lake in the low 30s and high 20s. By the time it rolled around to like 2016, 2017, their cost curve was showing those things running at like $16 and $18, around that number. So they assumed that all-in sustaining costs went away, and that these pure play mines were going to stay open. And the utilities, and again, we spoke to these people for years and years and years, and said, look, these guys, their costs are materially higher than you think they are. They need higher prices. And what did they do? They stayed out of the market. They could have easily signed contracts, and they chose not to do that. And so, Tim and Grant, I always say, they're statesmen. They're not going to say that. They talk about great partners that they have. Great partners there's no substitute for this stuff, right? There's not 500 mines that produce this stuff. There's only a very small handful of mines that do this. And you didn't see that. So now it's going to flip on its head, I think.
So if in that case, if with the enrichment capacity, how are SMRs even going to be a plausible thing in the next decade? Because if there's not even enough enrichment capacity to get to 4% lower in uranium for a reactor, how the hell are they going to find enough enrichment capacity to get it up to 18% enriched HALEU to supply SMRs?
It's a good question. There's a bunch of stuff going on there. You mentioned Segra before. My friends Art and Adam, who run Segra, the other uranium fund, they do a lot on the SMR front. They invest in some things there, and you might want to talk to them on it. I'm not smart enough on the technology front. Like I could barely turn my computer on. So as I started to look at like 70 different technologies that are out there, for me, my baseline was, I have no idea which one of these technologies are going to win. I'm sure a few of them will win. My head spins. I just want to figure out supply demand of the yellow cake and the other stuff. But on the SMRs, so we don't put any demand in ours from there. When I'm talking these numbers, I don't have SMR demand in there. There might be a little. I'm sure there will be a few that come into play. One of the things that I think is interesting that I've seen people try and run with, I don't know, but you saw Amazon sign a deal with Susquehanna Nuclear Power Plant for some direct offtake by co-locating a data center right there, because data centers consume so much power. And right, what's better than baseload nuclear power right off the grid? That could be something where, I don't know, I've seen numbers. Again, we haven't put in it makes my head hurt doing the math on trying to figure that all out, because I don't need it for our thesis to work. It probably incrementally is more, but I think what it does, and what I've noticed, it's so much of this I mentioned, I was half joking. I said utilities suck. I just think they play hardball, right? What I think though is, I understand why they play hardball. They play hardball because for years they thought their plants were closing. For years it looked like they were in a tough position, many of them. And so when like the U.S. Inflation Reduction Act came in and gave them a production cost credit, and it was able to give them a lifeline for years, all of a sudden I'm not going to lose my job tomorrow or in 6 months or in 2 years or in 5 years when it closes. There's a lifeline there. I think the same thing here. I think if there are nuclear power plants that are signing offtake deals with data centers, it just changes the psyche. It changes how buyers go to market, that they could see it tomorrow. They could see a future. So again, it's a swishy answer. I don't know. We don't use any of those SMR numbers. We don't use the data center. We don't use the micro reactor stuff. There probably is some demand for those in the future. I just don't. Since we don't need it for our thesis, we don't really use it.
Just overall, doesn't sound like they're coming anytime soon.
I wouldn't be smart enough to know.
I saw a headline a couple months back now on, I think it was Hinkley Point C, the big reactor, or relatively big, that they're trying to build in the UK. And I mean, the gist of it was that there was a massive cost blowout, and this isn't, an isolated incident in the West. Where I'm sort of going with this is, where does in terms of the demand come from in your models, East versus West type of analysis? Are you basing it a lot on the growth that we're sort of going to see out of China, India, or wherever? Or is there still a good portion of, Germany flicking these things back on, France maintaining, the US maintaining and growing?
Yeah, you're so rough numbers, right? 65% of demand comes from the West. 65% of supply comes from the East. As I look at demand, though, China's probably 55, 58 reactors going to, by 2030, probably 95 to 100 ballpark, buddy, in that ballpark. Uranium, as we think about it, a lot of what's happened is, so in 2017, if you were to read the headlines, it would have been the French, who have 58 reactors. They consume 35-ish million pounds a year of uranium. That's big. 75% of their electric grid is nuclear. If you read the headlines then, it would have been they want to go to 50 by late 20s, something like that. So it was weaning itself off. The UK weaning itself off. South Korea, new president, 2019 came in and said, stop construction on reactors. We're going to reduce dependency on nuclear power. United States, which had 95 reactors, it was one after the other. It was going to a series of closures over time. And Germany was doing what Germany did, which has been a calamity with their energy transition. But so there was a decline in nuclear power by the big users. Japan, who knew? You had 54 reactors, so like high 20s and 30s will be on the grid ultimately. Maybe we use, like in our modeling, a fraction of that. Even so, there's upside demand there. But just stemming the tide. Fast forward to today, right? You've seen a 180-degree shift in just those developed workhorse countries, big countries, where the French are not only not going to 50%, but they're going to build 14 new reactors over the next several years. So it's a huge turnaround. The South Koreans, same thing. The Japanese bringing on more. The United States, production tax credit saves it. Well, you see more, maybe not more, but it's not declining. So the delta in pounds just from that is meaningful. And then, so you do, where China's a workhorse, the UAE, you're seeing, but countries, one-offs that are building one reactor here, 2 reactors there. India has huge plans for reactors. We include some of it. We don't, I don't get really into the past 2030, because you start to get into, who knows, because you'll see hundreds that are in the development phase and all that stuff. You guys know it's who knows what tomorrow brings. So we try and do it with things that are more tangible. And that would be, so it's a combination of a stabilization of the decline in the West to even a slight drop of growth and growth in the East.
Can you reflect on your bullishness in the previous cycles to now, and how this one rates? Can you put yourself back in the shoes in 2007?
Yeah. In 2007, like I said, if I were doing supply demand math, I would have thought there was a surplus. So if I were that fuel buyer, I would have stepped out of the market, right? Because you'd say there's a surplus in the market, let everyone else get a little goofy. I know a particular fuel buyer here now who's an anomaly, and he's been out securing pounds since 2019 and 2020. But that's an anomaly. It's a weird set. Again, I said it's a broken, dysfunctional market, and it really is. If the spot market's broken, the price reporting is broken. It's not necessarily the spot prices and where a trade took place. It's the midpoint of the bid and the ask that a couple of brokers report on a daily basis to a price reporter. So it doesn't have to have traded. The long-term contract, for instance, that is reported, and again, it's the level of bullishness you ask. The long-term contract that's reported is not necessarily where the price traded. It's where somebody bid, we'll say offered in a price on a request for proposal. So there's 5 people, they're making up 10 people putting in bids to a utility to buy uranium, to sell them uranium. And, one of them put a lower price because they could, yet the utility chose the higher price one for myriad reasons: security of supply, they have geographic exposure, can do whatever they want. In that request for proposal, if it's reported to the price reporter, the price reporter takes the lowest offered price, even though it wasn't awarded at the higher price. So that's kind of like you selling your house for, $500,000, but somebody offered you $400,000, and the local real estate board recorded the sale at $400,000. That's not where it took place. It cleared at $500,000. So when you see long-term pricing here, what they're showing you is what the lowest offered price was, not where it was struck. So when I look at that, and I talk to this cohort of buyers, the very big fuel buyers in the world, they're all sharp, they're all smart people, they're almost all nuclear engineers. Every one of them are really bright. It comes down to what Charlie Munger always said: show me the incentive, I'll show you the outcome. It's no different here. There's not a financial incentive to call bottoms. They don't get paid for it. They get paid to secure supply, whatever that price is. So the larger ones who have mammoth needs, they're out there leading the market. Many of those have covered themselves, not totally, but reasonably. But a lot of them, the smaller ones, haven't. And they're the ones who are going to have to pay through the nose. Why? Because they don't have a team of supply demand people. They're not out checking the mines. They're onesies and twosies reactors. And all of a sudden, there's a lot of those around the world. And then one begets another. So I think there's apathy. I think there's lack of incentives. And when you just put the supply and demand math structurally long-term together, that's where my bullishness comes from. It's a different level of, it's a different, the thing I have to concern myself with every day is thesis creep, right? If you start looking for reasons why to be short or long something, in my case, long, if you start looking for reasons that are different than what you were there, because what you were there for isn't working, you need to exit the trade. But if your thesis there's nothing wrong with your thesis strengthening. Our original thesis was a supply shortage. That's it. Man, we didn't need. We just needed it to not implode. Now we've got a whole demand side. So it's supply driven. There's not enough supply. And out of nowhere came this demand stuff. I had no idea demand was going to all of a sudden do a 180. So that's kind of great. So I think, I don't know where prices go. All I can say is what I said earlier, I'm sorry to be repetitive, was last cycle, when prices really started hauling higher, there was not a surplus. There was not a deficit in the market. There was a structural surplus. And today, there's a structural deficit in the market. So when that got realized, by the way, is when prices started moving higher, when you started seeing contracting above the annual rate of consumption when they were restocking. You're just approaching that now with the deficit.
Something we saw, not really in the last cycle, but in the 70s and 80s, it happened in Australia in the exploration sort of landscape and big in the States, was these oil and gas companies, the biggest energy sort of providers in the world, looking at nuclear for very different reasons as they might do today. Is that something you've ever sort of, thought about, whether these guys get involved?
So we started a uranium company back in 2018. The United States at one point, they consume 50 million, let's round up, 50 million pounds a year. Back in 1986, they were producing 44 million pounds a year. Now they produce almost nothing. It's a little bit better, but a couple million pounds. But back in 2018, the prices were in the toilet. We just decided that this is stupid. The U.S. will have to produce more. Let's go lease some land. Let's find a company where it's gone bankrupt. The land reverted back to the Bureau of Land Management, but there's technical work out there that we could look at. We'll lease it and hold on to it. We eventually did that. The company's now gone. It's now public. In doing that, in looking at all the drilling data, the 70s and 80s and 90s was oil and gas everywhere, all over the data. So they were a major explorer and miner in the sector going back many years. And then you saw those disappeared and all went to natural gas, and they were looking at stuff like that. But one of the things that I've thought about, I have no idea if it happens or not, but nuclear's now got the green label. It's okay. Everyone hey, it's okay. Nuclear's green. We can say it. Ooh, okay. The European taxonomy it's part of. So there's this ability, and you just think of the sheer size of some of on a BTU basis. If an oil company is selling BTUs and a uranium company is selling BTUs, a pound of uranium, something like 180 million BTUs, and a barrel of oil is 7.5 million BTUs. You can replace a lot of reserves, not one for one, but the BTU equivalent of a uranium deposit versus your oil reserves is pretty significant, and you could do it for almost nothing.
Very last one from me, mate, because I know, as you say, you're always looking at ways to think, right, how is this wrong? Because I think a lot of us are thinking, right, how could this go wrong? But is the fact that it is such a big structural deficit there is not going to be enough uranium in the short term to make all this happen, and probably not enough enrichment, not enough plants and whatever. Is that the one thing that could break uranium in the shorter term within the next decade, that it just mightn't be enough time?
Yeah.
And the world might have to look at other means of energy until they get to that point?
Yeah. I think there's, there's so many things that can always go wrong. Or obviously a reactor can go down. That's not good for anyone. But you can't handicap that. You think about some of the things that, you could, in the United States, does the policy support get pulled? Do you start seeing reactors get closed? Highly unlikely. Could it happen? Yes. Do the Chinese, all of a sudden, they have been net buyers since I started looking at the investment in 2016, researching it, 16, 17, I kept being told all of the pounds that the Chinese had, and, 500 million pounds roughly. It was less then. It was 350 or something like that. Now it's, don't really know, but maybe 500, 550, something like that. If I go out to the end of the decade, it's very easy to see them using 60, 70, and that's going to keep growing. they're looking at multiple decades of uranium. In the US, and they want to keep 2 years, and in Western Europe, 3 years. They play a different game. I've always, you always hear people saying, oh, they're going to be in the market. Again, we're in the physical market. I don't see them selling anything. I think I see them being a net buyer, still accumulating. But should something happen there? Sure. Could the French do a 180? I suppose that's possible. But I think, as I think about like where it's the friction points, the friction is more for supply challenges, is where I see the biggest challenge. Where, if we were wrong, it would be all of these mines came online on time, budget wise, they'll figure it out, money wise. But permitting wise, building wise, most mines don't come online on time. But if they were able to get it, and then that would still, and this is where I go to it, if they came online, we're throwing the kitchen sink in it, it still doesn't solve the deficit. So then the next thing is, to your question, is there a point where you can't have the fuel for it? And it's something you have to think about, but there will be a price at which point somebody might be motivated to re-enrich tails, to do things that they could do and throw a ton of money at it to make this stuff happen. Again, the price of uranium would probably go nuts. It's really, though, in the short term, the hiccups really come from the demand side. Where I gain more and more conviction is when I see a bear point to this mine or that mine or good news on the advancing it project, and there's like, aha, like, okay, that's not going to solve the problem. These are structural long-term problems only that have occurred because the market price discovery mechanisms are broken. The financial incentives of the participants are broken, of the buyers are broken. And think about it, oil, a couple of $1 trillion market, right? There's tens of thousands of people buying and contracting and futures, and physical buyers. This is 55 end buyers at nuclear power plants around the world that are applying their commerciality to people, to the market, and they got it wrong, and they're going to pay through the nose for it.
Mike, the only other thing I wanted to say was in listening to a few of the previous interviews that you'd done, I heard a snippet that you said. It was to the tune of never underestimate the laziness of a professional investor.
Absolutely.
You were certainly not guilty of that, Mike. The detail you've gone into is phenomenal, and I'm actually looking forward to listening back to it. The only other thing that popped in my mind was I'm curious about the name Sachem Cove and where that comes from.
Sure. So my daughter was she has an autoimmune disease, and she was on some treatment and it didn't work very well, and she got very sick, and we thought we were going to lose her. And so she was 11 years old, and when you're in that situation, it's frightening. And thank God for some amazing doctors. They were able to get her better over a few months. And it was a summer, and we were, my family, our neighbors invited us up to their lake house on Lake Winnipesaukee in New Hampshire. And so we went up there, and it was the first time in a while that we saw my daughter smiling and having fun. And the house was located on Sachem Cove Road. And I had said if I start an investment firm, I would name it Sachem Cove, because that's the first time we knew that she was going to be okay. And so that's where the name Sachem Cove came from.
That's brilliant, mate.
Appreciate you sharing that personal story, and really enjoyed you chatting with us today, taking the time. I've learned a tremendous amount. So thank you, Mike.
My pleasure, guys. Thanks for having me. It was a lot of fun. I had great questions.
JD, I'll tell you what, I was stressing out a bit in the first hour, thinking, wow, we're out of our league here. But I learned that much in the first hour. The second hour got better, mate. That was that is high level, friggin' impressive stuff.
That chat just had sort of waves and layers and layers to it. I'm pretty pumped to listen back to it. I'm not going to lie, Matty. I was just like you at times there, feeling very much out of my depth, but there was that much, interesting and new stuff. This uranium thesis isn't awfully new. Heaps of people talk about it on YouTube or Spotify or whatever, but some of the stuff, Mike's talking about there, bloody fascinating.
Yeah, and how it's all going to tie together long term with just, the uranium mining and the spot market is such a small and part of what this whole thematic is about. Once you look at the vertical supply chain to get to power, once you go down the enrichment and conversion path. So look, far out. It's going to be a good show to watch, JD, the next 6 years, I reckon, Cobber.
Mate, the fact that we get to tune in with these people that have dedicated their 24/7 to this for years and years and years is pretty bloody awesome. So got a couple partners to thank for allowing us to do that.
Oh, mate, and the ones that are going to be helping power the nuclear energy world, JD, anytime exploration, and James at WA Waterboarders, get onto the big fellas and they will help you with anything uranium or non-uranium related. Simple as that. Who else have got, JD?
Our other partners, we've got VRIFY. Give Grant at verify.com an email. GetWet Solutions, DSI Underground, Silverstone, Brooks Airways, and last but not least, Matty,
K-Drill. Righto. Cheers, money miners. Hope you enjoyed that one.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.